If you've ever set a mousetrap, you know that exact moment of tension right before you step back.
Oh, yeah, absolutely.
Well, that is exactly what our stack of market analysis shows happened to Bitcoin this weekend. Okay, let's unpack this. Our mission for today's deep dive is to, really dissect that chaotic weekend price action and then compare how two leading corporate treasuries are navigating the volatility.
Right, because they're building completely different institutional moats.
Exactly. So Sunday's action was essentially that coiled spring, but instead of a mechanical bar snapping, it was exchange risk engines. I mean, Bitcoin dropped all the way down to $61,141, looking completely bleak.
Yeah, it looked really bad for a second
It
there.
really did. But then it violently surged past 64,000 and ultimately closed the week at 63,316. And by doing that, it perfectly recaptured the crucial 200-week moving average as a support level.
Which is a huge technical level for the people watching the chart.
Right. But this wasn't organic demand driving the price up, right? Like, this wasn't everyday buyers stepping in.
No, not at all. What's fascinating here is that the derivatives data reveals the actual mechanics of that bounce. When we look beneath the hood, this rally was fueled by a massive, $504 million in short liquidations.
Wow, $500 million just wiped out.
Yeah, exactly. Traders were heavily betting the price would continue to fall. But when Bitcoin hit a technical buffer instead and started to tick up, those exchange risk engines automatically stepped in.
Creating that forced buying loop.
You got it. Because those traders borrowed Bitcoin to short it, the exchange forcefully buys Bitcoin at market price to close out their losing positions, before their accounts go negative.
So the price gets mechanically pushed up to cover those trades, which pushes the price even higher, immediately triggering the next trader's liquidation.
It's a total domino effect, meaning this new $63,000 price floor is built on a very fragile short squeeze.
Rather than steady, long-term accumulation by spot buyers.
Precisely. And the usual retail and institutional spot buyers are largely missing right now.
Right, so retail derivatives are basically a house of cards at the moment. But, moving on to who is actually accumulating, there's a completely different blueprint playing out on the corporate side.
Oh, entirely different. Night and day.
Yeah. While retail traders are getting squeezed on leverage, corporate treasuries are actively building financial moats. First, you've got Strategy Inc. They just bought a massive 1,550 Bitcoin using $181 million generated from stock sales.
Which is a huge buy.
Massive. But what's really interesting is that this huge buy comes immediately after they made a tiny, almost negligible 32 Bitcoin sale last week.
Yeah, which naturally raised a lot of eyebrows across the market.
I mean, right. So what does this all mean? Because it was purely a token sale. They obviously weren't taking meaningful profits.
No, it looks like they just wanted to prove to the market and maybe to their own auditors that they actually have the internal plumbing and liquidity to execute a sale if they ever needed to.
Just flexing that they can sell.
Exactly. But that token sale led to some corporate maneuvering that borders on gamesmanship. You have Strive Inc., a competitor who saw Strategy's tiny 32 Bitcoin sale and had a very cheeky reaction.
Oh, I love this part. They bought exactly 32 Bitcoin.
They did.
Yeah.
A highly symbolic purchase of exactly 32 Bitcoin. They were basically laughing at Strategy's token sale.
I genuinely love the corporate pettiness. But structurally, even though both are exceptionally well managed compared to their struggling peers, their setups for handling this market are completely different.
Very different.
Right. So Strategy Inc. relies on heavy equity dilution, meaning they issue new shares of their own company stock to raise the cash for these massive Bitcoin purchases. But to balance that risk, they maintain a massive $1 billion cash reserve.
And that cash reserve is critical for their specific model. Because Bitcoin doesn't yield a dividend on its own, Strategy needs that billion-dollar fiat moat to service their traditional stock dividends and operational costs.
So if they didn't have that cash, a sudden drop in Bitcoin's spot price might force them to sell their Bitcoin at a loss.
Exactly. Just to pay those fixed costs. The cash protects the treasury.
Okay, so Strategy has a massive cash buffer, but Strive has a totally different philosophy. They are at an earlier growth stage, and they are completely avoiding senior convertible debt.
Yeah, it seems like they are trading leverage for pure safety.
Which is fascinating.
It is. Because Strive doesn't use senior convertible debt, they don't have aggressive creditors breathing down their necks with strict repayment terms.
Meaning, if the spot price of Bitcoin tanks, they aren't forced to liquidate.
Exactly. Their structural choice severely limits their buying leverage, but it entirely shields their corporate holdings from those fragile, liquidation-driven spot market drops we were just talking about.
So it's two incredibly disciplined blueprints for surviving the exact same volatility. I mean, on one hand, the broader market is relying on these fragile, automated short squeezes just to hold on to technical support lines.
Yeah, like that 200-week moving average.
Right. But on the other hand, you have top-tier corporations executing highly protected, if slightly competitive, long-term treasury strategies.
Which brings us to the real implication for you to consider as this space matures.
Lay it on us.
If a mere 32 Bitcoin token sale triggers symbolic corporate warfare today, what happens to market dynamics when these debt-free corporate treasuries start actively competing for a permanently shrinking supply?
Wow. Now that is a coiled spring waiting to snap on a scale we haven't even seen yet.